Okay, so welcome to Chapter 3. In Chapter 3, we're going to be talking about the concept of job costing, job order costing. And in the first few slides, we're going to differentiate between the other type of costing method, which is called process costing, because that's going to be coming up in Chapter 5. So again, job order costing is coming up right now. Okay, so the first objective here is we're going to talk about the differences between job order costing and processing costing systems and how you come up with the cost of a particular product. So again, the two basic costing types of methods are what they call job order costing or just job costing and process costing. And usually it's the type of company, what the company's operations produce or does actually will determine the type of costing method. So for example, if you're talking about process costing types of systems, those types of costing systems would be most appropriate for companies who mass produce single items, notice similar items. It could be things such as cereal, bricks, I'll just use that, bricks. Any of your processed foods you might find at the store would be mass produced, pop, soda pop, Coke, and stuff like that. Um, and the way you would come up with the actual cost of the product is you'd use some sort of averaging technique because you are producing so many of them and so forth. And of course, down below they give you some more examples. Paint manufacturers, oil refineries. Again, here's cereal. Again, think of items that are mass produced. Typically, would be using a process costing system. A job costing, or I like to call it job order costing, is basically used for unique types of items. So companies that custom make their products or they produce products in small batches. The way you account for it is you don't do an average, you do an accumulation of costs by the job. So here it says some examples. Hospitals, definitely I use this a lot in my lecture courses. I talk about building homes, advertising, and so forth. Think of the NFL whenever a team wins the Super Bowl. Each player gets a custom made ring from Johnston's. So that would also be a job order costing type of setup. So look at this particular exercise and let's see if you can figure out what companies would use job costing or process costing. You've got automobile repair, chemical manufacturer, custom furniture builder, movie production, paint manufacturer. So if you kind of think about what I just talked about in the previous slides, in the next slide we're going to give you exactly the type of costing that would most likely be used. Okay, so if you were thinking automobile repair, job costing, if you think about it, your particular automobile is being repaired, it may have a specific problem, you're going to be costed out by that particular job. A chemical manufacturer, like let's say you're making Roundup for pesticides and stuff like that, that's most likely mass produced, and if it's mass produced, it's going to be averaged, it's going to be used process costing. Notice they use the word custom furniture, custom, it's unique. That's job costing. A movie production is also unique. It's custom. That's job order costing. And then finally, a paint manufacturer, that's going to be mass produced. That'll be process costing. Okay, so next up, we're going to talk about the cost flow of your product cost and how they're traced to the jobs. And if you kind of go back to what I talked about in chapter 2, the actual cost flow is really the same. It's pretty much the same idea. Because again, if we're talking about a manufacturer, what you typically do, I'm going to draw this on this slide. You got raw materials. You need a raw material to produce a product. And those raw materials will get transferred into an account called work in process. And then from work in process, you go to your finished goods. So if you kind of follow this T account idea, the three types of cost categories that go into WIP, remember you've got your direct material is the first one, your second product cost is your direct labor, and the third one is going to be your overhead. Now when we get into this particular chapter on job costing, there's something special and unique we're going to do with that overhead account that's a little bit different than in chapter 2, but the basic idea of cost flow is the same. Materials flow to WIP, flow to finished goods, and then eventually it's all going to flow to cost of goods sold when you sell it. So again, as you can see on this illustration here, you've got the raw materials that go to WIP, work in process. Once you're finished with it, it goes to finished goods, and then once you sell it, it goes to cost of goods sold. And so remember, this cost flow system is really universal. It doesn't matter if it's job costing or process costing, or even some companies who use a hybrid of a little bit of both types of systems. The cost flow idea is really the same. Okay, so in this example, we're showing you a production schedule. This is for the month of December. As you can just see in this particular problem, is that they're making one, it's for a cross trainer. There's a treadmill, a couple treadmills, and notice the customer. You got a stock customer, and then of course you got one that says Chicago Bears, Chicago Bears. You can imagine if they are building treadmills and stair climbers for a Chicago Bears, they got to have special types of steel because some of the players are a little bit heavier, a little bit stronger. That's going to work the machine a little bit harder than maybe the average individual. So you can see how here you've got the orders, you've got start dates, and end dates in terms of when it's expected. And then of course, the big thing we're going to be doing in this chapter is once you know what the job is, the thing is how do you come up with the cost of the job? And just remember, it's still going to be the 3 product costs. Number 1, we need to know direct material. Number 2, we need to know direct labor. And number 3, we need to know the overhead amount. Okay, the overhead amount. Add those up, that's going to be your total product cost. And then of course the other issue that we're going to have is, before you can even sell these to the customer, sometimes you want to try to predict your product cost, because you want to make money. And that's a lot of what this chapter is about, is when we talk about the overhead, because remember, overhead is the one that's hard to predict. If it's direct material and direct labor, those are easy to trace, those are easy to predict. The overhead, because it's indirect, is harder to predict, and that's going to be our issue in this chapter when we get to the cost part of it. And so for this example, continuing with that production schedule, if this was the cross trainer, you can see in terms of the stuff that goes into it, you've got a bill of materials where you've got to order some stuff, you've got the quantity that they're looking to get, you've got the parts that go into the actual cross trainer, heart rate monitor, LCD entertainment, front and rear rolling base, and so forth. And notice these are all basically needs. Again, we'll get into the budget aspect later on in the chapter, but this is a pretty realistic type of setup in terms of when you start to produce, you have to be able to plan ahead. So planning ahead, obviously you got to have a purchasing process. Again, the budget is going to help you determine this later on, where you have purchasing orders, you're going to have shipping and receiving, and you got to have some way to keep the segregation of duties. You have to match invoices with the purchase orders and so forth. And this is all the logistics. The auditors always come in and do an audit as well. But of course, you have to be able to have the ability to buy and a plan to buy. It's all based on production. Okay, so as you can see in this job cost card, I talked about this already. So you've got, again, if this is for the cross trainers, you're trying to come up with the cost of the job, right? The product cost. So notice you've got product cost number 1, direct material, product cost number 2, direct labor, and then your product cost number 3, which is the overhead. So again, what you'll do is you'll add up these 3 product costs, you'll get a total cost of the job, and if you're making 50 units, you divide by 50, that's going to be your cost per unit. And then of course what you then do is you're going to apply some sort of markup to that cost to make your profit. Okay, so as you can see from this illustration, it's possible that you could have several different jobs taking place at any given time during the year. And in this one, it's showing you just a look of how this would look on your balance sheet. So in this case, you've got job 560, job 561, job 562, and job 563. And notice how all of these are split. You always have the 3 different product costs. Again, think of these as individual work in processes. You've got direct material, direct labor, manufacturing overhead. You have these for all of them. And since all these are in process, or you're still working on them, it would be actually on the balance sheet in that work in process account. Okay, so if you're just thinking about the cost flow aspect of job costing, so anytime you start to requisition materials, that's going to be product cost number 1, which basically we're going to call it direct materials unless they state otherwise. But this is the first step. Once you start to requisition these materials, you're basically starting to use them. And so for example, in this case, they're requisitioning some materials. In this case, it's a heart rate monitor, entertainment screen, and front and rear rolling base. So these are all going to be parts of your materials. that you're going to start to actually get those into the production cost flow aspect of it. And of course, once you do a requisition, there are all the internal paperwork where you're going to have what you received, again, what you've used, and what you balance. This balance, guys, that would be your inventory. So most likely is at the end of a period, someone would go out and actually count to make sure that that inventory balance is there, just for security purposes as well, but it also affects your financial records. But this is internally what it might look like once you started to use your raw materials. Now think about the second product cost, direct labor. Remember, that's our product cost number 2. So notice here's a labor record in terms of people that are working on producing the product. It's got their name, their rate, record number 324, what particular job they're working on. So this is how you trace their labor to that particular job. Labor, and then of course here's your cost. So notice once you started to produce your product, notice again, here's our summary. You've got your direct materials. Notice it has all the different amounts going into the product. You've got your direct labor, so this would be traced to the wage earners. And then of course the third one, which is coming up, is going to be the overhead. Once you get that, then you can get your total product cost. So I guess at this point you have $40,000 of direct materials. You've got $10,000 worth of labor, and then again, once you get that third one, you can then figure out your cost of the job. Okay, so before I get to that next third product cost and overhead, the idea or the problem here is because overhead is all of this indirect type of cost, indirect materials, indirect labor, other types of costs that are associated with the product. They are hard or harder to trace to an individual job. So what you're going to do then is you're going to do what they call a predetermined manufacturing overhead rate. So basically think of this as it's going to be an estimate. Okay, you're going to use some sort of estimate to actually allocate overhead to the jobs. And again, you do this for a lot of reasons. One reason in particular is because think of, if you're trying to get a customer, lots of times you're trying to bid a price to the customer. Well, you got to have ways to predict or estimate your cost. And because if you don't know how to put a price on your product. So this is a primary reason as you do this, is because again, you're trying to get customers ahead of time before you've actually produced them. But you've got to have a way to predict overhead and estimate overhead. It's all based on budget. It's all based on your history. You can take a look back at what you produced and make a good prediction. But it's all about using estimates because, again, lots of times you're trying to actually predict your cost before you've even sold it. But then here's going to be the back part of that that's going to be the problem. Because it is estimates, sometimes you do get it wrong. And so, if your estimated overhead is wrong when you had bidded it out to a customer, you could end up actually losing money on the job if you didn't estimate correctly. So again, in this next section, we're going to talk about the predetermined overhead rate and how you estimate the overhead or allocate the overhead to the job. And remember, this is going to be product cost number 3. Okay, so the basic formula is pretty simple to get that manufacturing overhead rate. So notice you've got a fraction, you've got a numerator that says total estimated manufacturing overhead. Guys, this is really your budget. Sometimes they might say budgeted overhead, but it's an estimate. And then you're going to divide by, it says total estimated amount of allocation base. Allocation base could be a number of things, but the idea is the base is going to allow you to track it to the job. It could be direct labor hours. That's a commonly used allocation basis, direct labor hours. You could have direct labor cost. You might use machine hours, machine cost, or whatever. But the thing is the problem will tell you what that base is going to be. So you read a problem, we'll get to it later. They'll tell you how they allocate the overhead. You need that base to get the rate. So again, they have to give you the estimated overhead or the budgeted overhead. You'll divide by this allocation base. It's basically allows you to trace. It's some sort of activity that essentially helps you trace overhead or generates overhead. Once you get the rate, you're going to take that rate and then allocate it to the activity to get the overhead. So again, the way you allocate, I always say allocate or assign is, again, I'm going to simplify here. You take the rate and you're going to multiply it by the activity. And that activity is the actual amount of allocation base used by that job. So if your rate is based on direct labor hours, the activity is going to be direct labor hours. If the rate is machine hours, the activity is going to be machine hours. Pretty simple. Take the rate times the activity on the job, and what happens is that's going to give you the allocated overhead amount, which will be product cost number 3. So if you look at this particular example, they tell you that the total estimated manufacturing overhead cost is $1 million. Cost allocation base is direct labor hours. It says total estimated hours for the year is 62,500. So again, they would have come up with this based on some sort of budgeting formula, looking at production as well. Job 603 used 500 of these hours. So to allocate overhead to get the third product cost for job 603, you first have to get the rate. So in the numerator is $1 million. The denominator is 62,500. You divide. Your rate is $16 per direct labor hour. Okay, so $16 per direct labor hour. So if that's going to be your rate, then the next step is to multiply by the activity. So you're going to take that $16 and you're going to multiply by the activity on the job, which just says job 603 used 500 hours. So you take the 600 and multiply by 500, and that's going to give you your product cost number 3, which is your allocated or applied or assigned overhead. So again, in this case, you would get $8,000. $16 again is the rate, 500 is the activity, and so once you multiply that, you get $8,000. That's your product. That's going to be basically your third product cost for this particular job, which in this case would be $8,000. Now remember, this is an estimate, not actual. This is all estimated. Later on, we'll show you what you do with the actual overhead as well. So as you look at this job cost record, we now have the 3 product costs. You've got number 1, again, direct materials. Number 2, direct labor. And then number 3 is your manufacturing overhead. So again, number 1 is your direct material. Number 2 is your direct labor. Number 3 is manufacturing overhead. So you've got 40,000 plus 10,000 plus 8,000, guys. So 58,000 is your total cost of the job. You divide that by 50 units, you get a cost per unit of 1,160. So again, if these are cross trainers, and this is how much cost you're allocating to each trainer, you can imagine the markup. So if you start here, this is your base cost to make it. You might charge your customer $2,000 or $3,000 or whatever your markup policy is. But the thing is you always want to make sure you're covering your cost, because if you don't, you're not going to make any money. So again, this is what a standard setup of a job costing system might look like. You still have the 3 product costs. The one thing about job costing is you use estimates with overhead. That's the difference in this chapter. So the rate, you need a rate times an activity to get the allocated overhead to the job. And so again, if you look at the concept of cost, so this is no different. Again, you've got your 3 product costs. You've got direct material, you've got direct labor, and then you've got your manufacturing overhead. So product cost number 1, 2, and 3, it's no difference. Everything is still going into work in process. Guys, even this allocated overhead, so that the amount we're using, the type of idea for overhead, it's not actual, it's allocated. Everything goes to WIP, and then from WIP would go to finished goods, to cost of goods sold. So again, this is cost flow. It is no different than what I showed you earlier in this particular PowerPoint lecture. Again, it's all, the cost flow concept is the same throughout the textbook. So again, just to reemphasize it, keep reemphasizing it, you got to get this down. Direct materials, direct labor, and I'm going to put allocated, at least for this chapter, allocated manufacturing overhead all goes to work in process, goes to finished goods, and then once you sell it, it becomes your expense. It becomes cost of goods sold. Okay, so in the next objective, we talk a little bit about in terms of determining, again, the cost of the job, and then how to use this again to make your business decisions. So if you look at some of the reasons of why you need product cost, obviously you're always looking to save money, reducing future cost of jobs. So you're always trying to be more efficient. You look at the way you do profitability. I think of markup. you have to have a cost to figure out what you're going to charge a customer. So you've got, looking at profitability, and again, affects your pricing decisions. It could affect in terms of planning, farther out discounts on high volume sales. So again, some of this gets into the budgeting aspect, which we're not going to do till later on in the semester. But it all ties back to your cost. Bids for custom orders. It helps you again bid out and customize your sales price for your individual customers. And it also is part of your financial statement preparation, because you still do internal reports on profitability, and you need this cost data because inventory is such a big part of a lot of companies, and it does affect cost of goods sold, so it does have a big impact on the balance sheet and on the income statement. Okay, so if you look at this particular example, it says Boston Heating and Cooling installs and services commercial heating and cooling systems. They use a job costing to calculate the cost of its jobs. Notice they tell you overhead is allocated to each of the jobs based on the number of direct labor hours. Guys, that is huge. You always need to know how they allocate the overhead. They have to tell you something in the problem about this. We just identified it. It says at the beginning of the year, they estimated that the overhead for the coming year would be $67,200. Guys, this is your estimated overhead right there based on your jobs. They anticipate 4,200 direct labor hours. This is your anticipated activity. So in November, Boston started and completed the following 2 jobs. So notice you got job 101, job 102. They give you product cost number 1, product cost number 2. What they didn't give you was the third one, which that's what we're going to have to calculate. It says they paid a $24 per hour wage rate to employees who worked on these 2 jobs. So again, to get the direct labor cost, obviously you got 180 and 74. You're going to have to multiply each of those by $24 to get the total cost of labor. That's pretty easy. Okay, so requirements. Part 1. What is their predetermined overhead rate? We'll get that. Number 2, it says calculate the overhead to be allocated based on direct labor hours on the 2 jobs. We'll do that. And then finally, we'll add up all of our product costs to get the total cost of each individual job. So again, here's our predetermined overhead rate. So they told us the estimated overhead was $67,200. The estimated activity was $4,200. We get a predetermined overhead rate of $16. And then I'm going to make a note, this is per direct labor hour. That tells us this is what we multiplied, this base, that's what we multiplied to get the allocated overhead. So for job 101, if we wanted to get the allocated overhead for this particular job, we take the rate, which is $16, the number of hours on the job, which is 180, that's the activity, we get 2,880. Guys, that would be your third product cost. All right. On the second job, same thing, you got the rate of $16. You've got the activity, which is 74. You get the overhead allocated, which would be 1,184. Again, that would be your product cost number 3 for job 102. And then finally, to wrap it up, I'm going to label these again product cost number 1 that was given. Product cost number 2, you had to calculate the labor cost by just multiplying that $24 per hour times the hours. And then the third one is the one we just did. This is your allocated overhead. Product cost number 1, 2, 3, you add it up. Total cost of the job is $25,200. Same idea for job 102. Product cost number 1 is direct material used. Direct labor, same thing, you had to calculate that using that rate. There's your product cost number 2. And then product cost number 3, we just figured it out, was $1,184. We added up, that would be the total cost of job 102. Okay, so then the next problem is because I said earlier that the overhead is an estimate, what happens at the end of the day when your actual overhead is different than the estimate? So we're going to either be over or under allocated, and if we are, we got to figure out what to do with it, and that's what we're going to talk about in the next few slides. Okay, so if you look at this particular example, it says Fed Corp allocates manufacturing overhead based on direct labor hours. Total estimated overhead for the year is projected to be $200,000, whereas the total estimated direct labor cost is $140,000, whereas total estimated direct labor hours to be worked is $10,000. So right away, you got to be careful with these problems. They will tell you exactly how overhead is allocated. In this problem, it's based on direct labor hours, not direct labor cost. So even though they threw in this $140,000, we're not going to need it. because that's not how they allocate the overhead. So in this case, that's kind of like a distractor. So you take the 200,000, divide by the 10,000 to get the predetermined overhead rate. So here's your rate. Again, you take, again at the bottom, 200,000 divided by the 10,000. So your overhead rate is $20 per direct labor hour. So you might ask, well, why did they give you 140,000? Well, you're going to need that to get the product cost. But again, for the rate, you got to be careful. Sometimes you mess up. For the rate, it's based on the hours, not the cost. Now, so let's assume it says actual overhead for the year was 190. So this is at the end of the year. They figured out the overall overhead, actual. And then it says a total of 11,000 direct labor hours were worked. Again, this is actual. These are not estimates. It says using the overhead rate of $20 per direct labor hour, it says how much overhead would have been allocated to all of their jobs. And remember, they would have used this $20 estimate as they're costing out their jobs, because at the time they didn't know what the actual was going to be. So our job is, we need to figure out, first of all, what's our allocated overhead. So we're going to figure that out. And then once we get that, then we're going to compare it to the actual overhead. And the actual overhead was 190. So we're going to see how close we got, and then we're going to figure out what to do with the difference. All right, so right away we see there is going to be a difference. So notice down here at the bottom, here's your overhead rate of 20. This was your activity. This is what would have happened during the year. So our allocated overhead is $220,000. So do a quick comparison. Actual overhead was 190. So we're way over. We allocated more overhead than what we actually incurred. That could be an issue. Okay, so we're next going to look at what happens when the actual overhead is different than the allocated overhead. So that's going to be the issue again to deal with, is comparing the allocated overhead that went into the jobs versus the actual expense of the overhead that you actually incurred, and what do you do with the difference? Okay, so in this example, again, we had actual overhead of 190,000 and the allocated overhead was 220. So again, that's a difference of $30,000. And again, so we would rather be closer to the actual, okay, because remember the allocated is an estimate. And so in this case, we missed the mark by basically by $30,000. So now again, what are we going to do with that $30,000? Well, the next slide we'll talk about what you do with it. So again, the basic idea of either under or over allocated overhead. Again, if you under allocated it, it means that you costed too little. So basically you are under the actual. If we over allocated like we did in this particular example, that means we put too much cost into the jobs, and therefore our job is going to look more expensive than less expensive. So we'll talk later about the rationale in terms of the effects of the business, but in terms of accounting, what do we do with that under or over allocated overhead? So again, I talked about this already. You estimate it, and remember the estimate is usually never going to be the same as actual. You just want it to be close. Okay, that's the idea, is you want to be accurate. That's going to be the whole theme here, is accuracy. But the solutions are either you're going to either, number one, adjust cost of goods sold, or number two, you can prorate it among all your other inventory accounts. We're going to primarily follow this approach. We will assume that everything has been sold at that point, okay? But there are some times when you could have, under or over allocated the overhead, and you could have maybe not sold the product just yet. Then you can take that difference and allocate that difference back to one of these accounts in your balance sheet. Most likely finished goods inventory, but we're going to use cost of goods sold most of the time. Now, some other types of costs that do come up again in a manufacturing setting is the idea is non-manufacturing. And again, I'm just going to give you the word period cost. These are basically period cost, which basically means you expense these as incurred. We are essentially following the gap in terms of our product cost and the idea of inventory, because remember, under GAAP, inventory is only expensed when you sell it. So we're basically following GAAP, the stuff from financial accounting, when we're looking at our product cost for inventory. The period cost is basically your selling, your general admin and selling types of expenses, and you basically would expense those as incurred. Okay, so in this particular example, it says that the foundry uses a predetermined overhead rate to allocate overhead to individual jobs based on machine hours. So guys, that's going to be our base, is machine hours. They tell you that in the problem. It says at the beginning of the year, this is what they expected to incur. So guys, these are the estimates in the problem right here. You've got estimated overhead, direct labor costs, and this is the number. Here's your estimated activity. There's your machine hours. It says at the end of the year, the company had actually incurred the following. So guys, everything here is the actual numbers. This is actually what happened. The above group of data is the estimates. So we're going to walk you through these requirements. Number one, we'll get the overhead rate. We'll allocate the overhead. We'll figure out if we, how much was incurred. This is, basically were we over or under, and by how much. So notice, to get the rate, you take that estimate. This isn't, you go back to the previous slide. Here's your estimated overhead. There's your estimated activity. Our rate is $8 per machine hour. Next up is you have to allocate it. So you take the rate and you multiply it by the activity. And the activity, go back and find it. The actual machine hours were 54,000. So you take 8 times 54,000. This number right here, guys, the 432, that's going to be the allocated overhead to the jobs. So then the next step will be to compare this to the actual overhead. And so we figure out that the actual overhead is 432,000 versus 490, which is the the actual is 490 and the allocated was 432. In this case, we are under allocated by $58,000. We did not put enough overhead into the job, so our costs are going to be too low. Okay, so now we're going to walk you through the journal entries on how to record the job order costing problems. We'll walk you through the journal entries on how to correct the over or under allocated overhead as well. Okay, so a lot of this will be very similar to financial accounting in terms of a journal entry. So in this case, it says that you bought some raw materials for $90,000. You debit raw materials and you credit accounts payable. So this is your basic debit credit purchase type of entry, just like you would do in a bookkeeping system. Okay, so next thing you do is you're going to start to use the raw materials. If you look at the cost flow, so it says assume that they used $112,000 of direct raw materials during December. So let me draw you a T account down here just to kind of give you another visual. So remember, just as like previously on how the cost flow works, raw materials flows into work in process. So the first product cost is direct materials. So notice we're going to be debiting WIP, and you're going to credit raw materials to get that out of that raw materials account. That would be how you would record a materials transaction. Notice in this one it says that they have $90,000 of indirect raw materials. Now notice the indirect raw materials go to an inventory account called manufacturing overhead. So I'm going to draw this as the T account, and I'm going to put on the debit side, I'm going to put actual, and on the credit side, I'm going to put allocated overhead. So use this as a template as we go through these. So any sort of indirect materials, indirect labor does not go to WIP. It goes into this account called manufacturing overhead. Think of this as kind of like a control account. It's going to help us track our overhead account, overhead numbers, to compare to the allocated. So notice we debit the overhead and we credit raw materials inventory. Okay, next one is direct labor. Notice this is product cost number 2. And again, I'll draw the work in process T account. Remember, reminder, as our 3 product costs that go in here are direct material, direct labor, and manufacturing overhead. This is the direct labor. It says it's $30,000. So we're going to debit work in process, and we're going to credit a payable account for $30,000. Notice you could also have indirect labor, and notice because indirect labor is overhead, so I'm going to again set up my manufacturing overhead account. The actual goes on the debit side. The allocated is going to go on the credit side. We've got 13,000 of indirect labor that gets debited to manufacturing overhead, and again you're going to credit a wages payable. Okay, so now it says assume Life Fitness incurs other indirect manufacturing costs such as plant utilities, plant depreciation, plant insurance, plant property taxes during the period. Guys, all this stuff is actual overhead. And so all of this is going to be debited into manufacturing overhead. And then of course, look at the credits. You could have accounts payable for the utility bill. The depreciation goes to accumulated depreciation. For the insurance, obviously, if you did some adjusting entries, you could be crediting the prepaid insurance account. So this could be on an adjusting entry. And the same thing with your property taxes. But again, the point is again, I'm going to draw this up again. Manufacturing overhead gets debited for all of the actual overhead, and it's going to get credited for the allocated overhead. Okay, so to allocate the overhead, again, it says assume we got a job 603. They use 500 direct labor hours. Job 604 used 1,000 direct labor hours, and the rate is $16. So remember, you always take the rate, multiply it by the activity, and then lo and behold, here is your allocated overheads, 8,000, 16,000. So notice again, you debit. The allocated overhead gets debited to work in process, and the credit to your allocated overhead goes to the manufacturing overhead account. So again, so for manufacturing overhead, again, I'll say this again, you've got the actual that goes to the debit side, and the allocated goes to the credit side. Remember, so WIP, just to remind you, work in process always gets the three product costs, always gets direct material, gets direct labor, and now with job order costing or job costing, now it gets the allocated manufacturing overhead. Okay, so then once you've actually finished the job, so notice here's your product cost 1, 2, 3. You've got your total cost of your job. You divide that by how many units are in the job. The cost per unit is $1,800. Now, once you figure this $108,000, it needs to be transferred to finished goods. So you'll debit finished goods and you'll credit work in process. This is basically, again, just repeating your cost flow, but in a journal entry format. So again, here's basically your basic accounting entries on sales. So notice it says you sold some of these cross trainers and treadmills. These were sold on account, so you're going to be debiting your accounts receivable. You'll credit your sales revenue. And with perpetual inventory system, you have to also update inventory. So whatever accounts you sold, guys, here's the cost of each of these. So you're going to debit cost of goods sold, and then you're going to credit finished goods. This is pretty much just like financial accounting on recording sales of inventory. And again, as a repeat from financial, same idea. You have all these other costs. These are essentially your period costs. Notice you got your salaries and commissions, rent, marketing. You have to debit these expenses, credit your appropriate payable accounts. Now it says assume Life Fitness incurred $25,000 in manufacturing overhead and allocated $24,000 to the jobs. So if I drew my T account up here, so manufacturing overhead, so remember actual goes on the debit side, so that's the $25,000. That's actual. The allocated goes on the credit side, that would be $24,000. So if I said, give me the balance of overhead, you would say, in this case, you'd say it's got a debit balance of 1,000. We are, in this case, looks like we are under allocated. So to close out this overhead account, to make this go to zero, we're going to have to credit the overhead account. In this case, like I said earlier, we're going to be debiting cost of goods sold. So in this case, we undercosted it. We need to adjust cost of goods sold by increasing it. By increasing it, we're now appropriately accounting for our inventory expense. And this is how you close out overhead. Now, if this went the other way, sometimes you might have to debit overhead, but I would just say set up a T account, get the balance. In this case, you have to credit overhead to get it to go to zero. If it was on the other side, you'd have to debit it. So this is basically the idea how it works. And of course, here's your basic standard income statement. Notice sales, cost of goods sold, gross profit. This cost of goods sold obviously would have been adjusted once you closed out that manufacturing overhead account. Okay, so most of this PowerPoint illustration has been about manufacturers, but service firms could also use the same idea. Even though you don't have a tangible inventory product you're selling them, you can still look at a job in terms of material, labor, and overhead cost, and then of course take that job and then mark it up to a client. Lawyers do this all the time. So do the CPA firms when they audit publicly traded companies. So again, the costing is basically the same. The cost flow is not going to change. Again, the big difference is you typically don't have inventory to speak because, again, you're a service industry. You're not selling a tangible product. But the cost flow is essentially the same. So notice that they say walk you through some steps, but it's basically the same idea. you have to get a predetermined overhead rate. And it's basically depending on the company, depends on what you're using, your base is going to be. But you're going to have a base, you're going to take that rate and essentially take the rate times the activity that you identify, and that's basically how you're going to allocate the overhead. And of course, once you get that job, just like any other type of company, you'll mark up your job cost plus the markup. That's basically what you're going to bill to the client. So this should tell you that the job cost of the product is very important to know because it does affect your profitability. All right, so take a look at this example. It says Zuka Associates, which is a law firm, hires an attorney at a salary of $192,000. The law firm expects her to spend 2,400 hours per year performing legal work. Indirect costs are assigned to clients based on the billing hours, so that's going to be our base. Firm attorneys are expected to work a total of 28,000 direct labor hours this year, so that's going to be, there's your base right there. It says before the fiscal year begins, they estimate the total indirect cost, again this is your overhead, will be $840,000. So remember, the way you're going to get your overhead rate is you'll take that $840,000 and you're going to divide that by the 28,000 billing hours. So that's how you're going to get the rate, just like you did with the other system. So number one says, what would be the hourly rate cost to Zuka Associates of employing Smirk? Again, you could figure out the hourly cost by taking her salary and dividing it by the hours. We can then come up with the rate. It says that they work so many hours for this client. We can figure out the direct labor cost, and then we could also do the allocations based on our rate here. So again, it's going to be the same idea in terms of cost flow. In this case, most likely your two major costs will be direct labor and indirect labor cost. So again, to get the hourly rate, you just take their salary, divide by the number of hours per year. So here's your basic, cost per hour salary. And if they went for client 367, if they worked 15 hours to this particular client, you multiply this by their hourly rate. This would be your direct labor cost for that particular client. And then next up, to get the overhead rate, like I said earlier, you take that $840, that was your estimate. You divide by the total hours, so your rate is 30. And again, you take the same 15 actual hours times the rate. So this would be your allocated manufacturing overhead to this particular client. And then of course you would add this to the direct labor cost to get the total cost of the job. So again, here's your direct labor. So basically here's your direct labor cost, here's your manufacturing overhead. Notice what's missing, there is no direct materials, this is all you've got. So total cost of the job is $1,650. You'll then mark this up to sell that as a bill to the client.